Hi, everyone. I'm James Garbutt,
And I'm Denny Dumas.
and this is the Garbutt Dumas Real Estate Podcast. Hi, folks. I'm joined by Denny and Monica, and today we're talking about investment. We get this question a lot because mortgage rates are so low. The market is so active. Real estate's been a story over the last little while. And the people that are happy with where they're living are wondering what to do with their excess money or ability to get financing. Should they refinance their home? Should they buy an investment property? What do they do? And so if you're looking to invest in 2022 or thinking about it, we want to give you some tips or things to think about because a lot of these items are coming up in regular conversations that we have on a weekly basis to try to help people do some soul searching on what type of investment they might be looking for and whether or not they're even suited to be a landlord or a real estate investor.
Seems like even more often in the last year or so, we're getting this question of, I have a little bit extra cash. What can I do with it? What type of property? Where should I be looking? And I actually had a conversation yesterday, Jamie. And this guy I was chatting with brought up a stat, and I have no idea if it is a true stat or not. But it's an interesting stat to think
Let's
about
preach
it
this
and
stat
chat
as much as possible.
Well, it's interesting to discuss at least. And he said people have 50% more cash than they did coming out of COVID than they did going into COVID. And I think the reason behind it is no one got to travel, so there was nothing really spend money on. You couldn't go out to restaurants for a long period of time. And so a lot of people shifted to working from home. You're not paying for gas. Like there was a lot of things that normally you're paying for monthly that now you're just saving money. And in thinking about that a little bit, I don't know if that 50% number is accurate, but I think it's a valuable idea to even think about and kind of in our real estate world, shift how we're marketing ourselves as real estate salespeople into potentially adding an investment portion to your business. A lot of people are going to be bringing this up over the next year or 2 years or 5 years. The government dished out a lot of money, and a lot of people want to put that into something. And Greater Vancouver real estate has historically been known as bulletproof, and people feel like it's a really good long-term investment. And so it's important as a realtor in Greater Vancouver, I think, to understand this side of our business.
I think it's important if you want to be an investor to analyze the type of investor that you want to be. Do you want to be a landlord? Are you handy? Are you able to fix things, or will you have to hire somebody to fix things in your investment property? Do you want to run an Airbnb? Are you going to get cleaners in and out and a bottle of champagne and whatever every time that someone moves in and out? What type of investment do you want? Understanding that one-bedroom condos usually have a quicker turnover, so you have tenants moving in and out rather quickly versus if you have a townhome or a detached house that you're renting, you're going to have them stay in for a few years usually. So you have to figure out what type of investor you are and the kind of commitment that you want.
Yeah. I think that's a real good statement. I think one of the first questions I tend to ask people is, how do you feel about being a landlord? You know, being a landlord is a big step when you've never been a landlord. And arguably it can be a great experience or a terrible one. I've had terrible experiences and I've had great ones, but there's certain properties and product types that will generally attract a lower maintenance tenant. You can always have a property manager. If you buy a one-bedroom condo on the SkyTrain line anywhere, you're likely to attract a professional. And if you don't choose the wrong one, it may be as simple as checking in once a year or whatever your insurance requirements are if you follow them. So, having an investment condo can be a very low-maintenance investment. And I think it would be good to kind of highlight what are some good reasons to invest in real estate, at the moment. And because people are wondering what to do with their money, and it's stocks, it's real estate. Those are the two common ones. There's lots of other options, NFTs maybe. But, when you look at the mortgage rates and you can get a closed variable right now for what, 1.35% around there, that's less than inflation. So if you have access to a $500,000 mortgage at 1.35% and you have the down payment available, it is better to, in my opinion, to own real estate at that low rate that is, ideally upward trending real estate. as opposed to having it sit in cash for obvious reasons. So you're taking out a loan that you're paying the lowest interest I can recall, and it's lower than the inflation rate. So you're going to hear you hear this term inflation a lot right now, and real estate is often seen as kind of like an inflation-proof asset. So taking advantage of the low rates is a very good reason why you might want to consider an investment in real estate.
It's an interesting investment too that you're using someone else's money, or the majority of your purchase price is someone else's money. And at these really low interest rates, even if you're cash flow neutral, they're it's a very appealing investment to invest in real estate. I've always really liked the idea of putting 20% down, 80% is funded by the bank. And if I'm cash flow neutral or cash flow positive, it's paying itself off kind of thing, versus like investing in stocks or whatever other items. For the most part, you're investing 100% of your own cash.
Yeah. If you set up a margin account in your own investing, I think you might get, I don't know, 75% like loan on your portfolio. So if you had $100,000 of Apple stock, you might get a loan of $75,000 on that. But if you had a $100,000 down payment on an 80-20 loan to value, that would be $500,000 worth of real estate. So it's, you're able to lever up. Very good reason to do it. There are good reasons to do it. There are bad ones. What is some, potential con? There's been a lot of market gain lately. Are you jumping in too late? What happens to prices when rates go up a little? And so some people have that genuine sense of feeling like they missed the boat. Been a realtor for almost 14 years now. That sense doesn't seem to go away. So the sooner you get on the boat, the sooner you lose that feeling. But
I'm a big fan of like pulling the trigger when it comes to investment. Align yourself with somebody who knows what they're doing, another agent that knows what they're doing, but you have to kind of jump in at some point. This year, I saw at least 5 or 6 properties in Chilliwack and Abbotsford that were in buildings that allowed rentals. And normally, I think in years past, maybe in 5 years ago, I would be like, oh no, you don't really want to invest in Chilliwack. Like, I don't know, the rent isn't that great. The upside potential isn't that great. I would have been wrong. If you had sold your property this past year in Chilliwack and you'd been renting it for 5 years, you would have made a great profit. And rent is kind of an interesting topic in itself. Like, you can almost get the same amount of rent in Chilliwack that you can get in, say, Maple Ridge or somewhere like that, but you're spending a lot less on the property because people who need to rent. And rental standards are pretty much the same in those areas. So if you can move a little further out with your investment, it's going to be more affordable and you're still going to be cash flow neutral or positive. And you have the same type of thing happening. You can get properties there for under $400,000 still. Most people can get approved for a mortgage under $400,000. So
I found that, you're using an example there of like the rents don't change much from location to location. I found like you take Brentwood, Burnaby, inner city, a lot of rentals in that area, a lot of towers going up. I'd have to look at the latest one-bedroom rates, but maybe for a moment there, a new one-bedroom might get around, so call it 2,000, and now maybe it's 1,900. But you could buy a one-bedroom in smaller communities that are desirable. So, like on the island, say, nice parts of let's call it Sydney on the island, or Parksville, Courtney Comox. One bedrooms in those markets, they're significantly cheaper, but the rental rates are very close. Like I saw examples of one bedrooms now close to the water in nice small communities on the island, renting for $1,800 a month, and townhouses. Denny, you might have a comment there on townhouses on the island, but compare the rates. So the smaller, I guess, in short, smaller communities outside the city, the numbers work far better.
Definitely, yeah. You're still getting the rent cash flow that you're looking for, and sometimes you're spending less, which is you don't have to get a fancy condo like you said in Brentwood or downtown. There's newer products further out that are less risky.
You go Penticton, Kelowna Island. I don't know the prices all over the place, but one common theme is if it's a nicer, smaller community where people seem to vacation in the summertime or has lots of outdoor amenities, the rental rates are very comparable to the city. Maybe not Yaletown rates, but like suburb city rates.
Even buying that property on the island, looking at one bedroom condos in that neighborhood as well, which is Couch and Valley area, there was one bedrooms in a 1-year-old building selling in the 300 to 325 range, and they're renting for 1700 a month. Versus buying that Burnaby one bedroom in Brentwood that probably costs you now 550 to 600,000 is renting for 2,000, 2,100.
Yeah.
The math just works so much better in areas that are a little farther away from the city.
If cash flow is one of your high up criteria, it's better outside of the city. And if you're going to go outside of the city, then you have to ask yourself, are you willing to maintain this asset? Is it worth it? Is it worth the trips there? So one comment that I would just make from past experience, if you do buy one condo, one townhouse outside of the city, I'd suggest you do it somewhere where you enjoy going. For those periodic check-ins, you enjoy that trip. I mean, obviously you can get a property manager and put it in someone else's hands. That will affect your numbers. Rentals can be quite low maintenance the moment you find a good tenant. But yeah, I mean, the option is property manager or pick a city that you enjoy going to.
So my favorite type of investment, the one that I get the most excited about, is when you upsize for yourself and keep the property that you've already paid into that already has appreciation and you tenant that property. It's kind of the biggest no-brainer for first-time investors. If you already own a property, you have a condo or a townhome, and you're thinking about upsizing, consider finding out how much equity you have and what type of property you could upsize into if you kept that property. It's something that's overlooked so often, and it's something that's really, really easy to do. You already have the property. You've already paid your taxes. You've already invested in it completely. Keeping that property and tenanting it and then upsizing with your equity is pretty much the biggest no-brainer when it comes to investing.
Would you say one of the biggest intimidating factors about real estate is coming up with the down payment, right?
For sure.
For a lot of young people that are in this situation that are potentially looking to upsize, it's intimidating to think about owning two properties, knowing the final expense of them. So let's say you have this 1-bed or 2-bedroom condo that's worth $650,000, buying a townhouse that's now worth 1.1. It's almost intimidating for people to think, oh my gosh, I'm owning almost $2 million worth of assets or real estate, versus what the really savvy, like younger investor type people are doing is they're owning that property for let's say 5 years, that 2-bedroom condo. They bought it for $450,000. They've been paying their mortgage. They're now refinancing that property to take some equity out, probably pretty close to 20%, to buy that next investment property, which is what Monica's talking about. And a lot of people don't even know that's really an option. And so it's something we're suggesting all the time to just have the conversation with your mortgage person. Look at numbers of if you are refinancing to pull some equity out to get to 20% on that new purchase, what the rental rate is going to look like on that condo that you live in now, what your monthly expenses are going to look like compared to that rental rate. And in a lot of circumstances, it is a lot more doable than people think.
Often a lot of people don't think of the idea of keeping both. Like they sell one to upgrade to get to a bigger home.
Yeah.
You get to a house with a suite. That's a good hack too, to get some extra income there as well. But in Monica's example here, you may not live in the perfect investment property type, but if you just refinanced your property to upgrade your home, and your existing property didn't hold you back, you're saving a lot of transaction fees and potential headaches of selling your place to buy an investment condo to rent out versus just keeping your place and sticking a tenant in there. There's a lot of advantages to holding, and then reassessing and not impulsively selling. The one advantage of just holding and putting a tenant in a property that you own is you're going to get a feel for being a landlord. You're going to have more clarity on whether it's for you or not for you. And you're going to just know more about what you're looking for in future investments. You got to stumble your way through this process.
Yeah, being a landlord is hilarious. I think all of us are landlords, right? Yeah?
Yeah, oh yeah.
All of us are landlords.
Yeah.
So the things that come up, are really funny. You're going to get calls because the fireplace doesn't work, and you'll show up and you'll just flip the switch a little harder than they did and it'll come on. It's a little bit hilarious and ridiculous, but it's totally worth it. Yeah, it's totally worth it.
I think one thing to think about is whether you're looking for cash flow or upside potential. There's certain, and I think that might come down to what stage of life you're at or where your net wealth is at. For people that are just starting out that don't have a lot of wealth, I think cash flow is an important consideration. If you're relying on upside potential and you're eating a monthly payment or your just cash flow is going out the door every month, that can be hard over a period of time. Cash flow just reduces the risk because you're not as vulnerable to market fluctuations. So for younger investors or lower net wealth investors, I think cash flow is an important consideration. And oftentimes when people are asking us, where do we invest? Um, for me, it's hard to say right now that one market will outperform the other when we're comparing suburb options within the city. Like Port Moody has clearly outperformed New Westminster in the last 2 years, but in 2 years ahead, will that be the same? So I often try to eliminate the thought of saying, hey, I don't know if Poco, New West, Burnaby South, or Port Moody is going to be a better cash flow investment for you over the next 5 years, 10 years. I think it's more important for you to, well, what's your budget? Because that might dictate it. And knowing those markets and knowing there's always certain buildings that are more affordable and the right age and the right location. In New West, often I'll refer to like the news development. News development is these 3 towers that were built in the early 2000s. So they're not like, they're concrete exteriors. They're not leaky condos. They're close to the SkyTrain. And they're far cheaper than buying a brand new condo. And they still are a newer condo. So for me, I like that 10 to 20-year-old newer condo that's in the great location that's a little cheaper than the new construction. That's what I typically suggest.
Oh, for sure.
Yeah.
I think you touched a little bit on like the price points, and you don't have to spend a lot to become an investor. I think that that's a big misconception. You can spend a very little amount and get in the game. And it's a much better idea to choose the building specifically than to necessarily choose the city or neighborhood. A building that is in the right age range, that you're not spending $5,000 on levies here and there if you don't have it. If you're a first-time investor and you're just kind of getting your feet wet, I would highly recommend getting into that age range that James was talking about. 8 to 20 years is perfect. And if you can't do that, then look for newer places, but look in areas like we're talking about on the island or a little bit further out. You're not going to get that big appreciation return on your investment typically that you would get on places closer into the city, but you're going to start paying off that mortgage, and eventually you can use that property to leverage something else, maybe to buy your dream home or maybe to upsize your investment and buy a bigger condo.
And why don't you share an example that you have Port Moody's a great example market, I find, because the rental rates, it's been winning in COVID and I guess losing for buyers and losing for tenants, but winning for property owners. You had an example of a condo rental.
Oh, yeah. Well, we've had a few clients buy and sell condo investment properties in Port Moody in this past year. Most of the 2 bedrooms are renting between $2,500 and $2,800, which is something that I never thought would happen. And you can still get them between $550 and $650. And that $2,500 to $2,800 is really good. I mean, you're going to pay off the mortgage really, really quickly. The next step from there for investments is really like a lot closer to the $1 million range, and then you're getting around $4,000 a month for rent. So it kind of depends on where you want to land. But we had a condo that a client had purchased earlier on in the year, and then their life changed, and they decided they needed to move. And we had an investor purchase the property for about $100,000 more than he bought it, which was awesome. But they were so excited about the investment because before they even took possession, they had picked up keys from me a few times and showed it to a few tenants, and they rented it out for a little over $2,800 a month, and their mortgage was covered. And it was actually 2 brothers. Their mom had drugged them to see this place. I'll never forget. They were so cute. They're in university, and they'd each saved some money through the summer working so that they could have a deposit, and their mom was helping them get the mortgage. And so they showed it to a few tenants. They had it paid for, and they were just so excited. They couldn't believe that they were real estate investors. And they were in university. They just saved the money and teamed up, and mom helped them get the mortgage. And now they're property investors in Port Moody. I just think it's really cool. Like their whole future's ahead of them. They don't live in the condo, and they live at the university they go to. But when they graduate, they'll have a little nest egg. It's pretty cool.
It's not I would say it's not realistic or be very challenging to find a cash flowing property if you put 20% down in the city. But getting to a break even point is a win. And even if you have a little bit of money going out every year, keep in mind you are paying down your principal and you are getting market gain and you are leveraging on bank money for the most part of the asset. So I'd like to think rental rates go up over time. And if you're patient and you buy a condo in a desirable market, I would like to think most people would be happy with that type of investment. The ones that are fed up with being an investor are the ones that end up having a property with problem tenants or, life changes, and often I find it more often in detached. But
yeah, the maintenance on detached is a big thing to consider. Yeah. And, when people get tired of their investments, it's usually because they're not shuffling the deck quick enough. We have clients that have owned the same investment property for 20 years. That's too long. It's too long. You have to change it up a little bit because when you bought into the building, it was only 8 years old, but now it's almost 30 years old, and there's maintenance that's needed. So you have to be an active investor and move your cards around a bit.
Absolutely. I just want to touch on the different sort of general types, and I wouldn't mind kind of getting the round table here of what we tend to like individually. So, landlord versus not being a landlord. How do you be a real estate investor and not be a landlord? Well, one, you could go after pre-sales, that delays you being a landlord. So there's the pre-sale option there. There's the option of having a property manager. There's the option of buying into a REIT, which is a real estate investment trust, I think is what it stands for. Or there's multiple companies out there that work in, say, Saskatchewan or areas that there are far better numbers that, you can invest with real estate investors in other parts of the world that have a general high return. So those are the non-landlord ways. The landlord way is either go for cash flow, you buy the typical 1-bedroom or 2-bedroom condo in the city. If it's inner city investments, we're often leaning towards condos or the house that has a suite below. That has a little more, if you can get a detached home with a suite below, get an up-down rental. Depending on your wealth and how important cash flow is for you, there's a very big difference between going after, say, land or a detached property with a good lot that has upside and redevelopment potential versus something that is currently at its full potential. So I've often myself in the past been lured by upside potential. And I have mixed feelings about it. Don't know if I'm doing it right, but I'd be curious to know, when you look at the different types of investment options, which ones you're more drawn to or which ones you more often find you recommend for clients?
I think just the type of demographic that we often work with is more concerned about cash flow and future sellability. So when you talk about investing outside the city, like I purchased a property on the island this year, I went into that understanding that in slow real estate markets, that could be a very challenging product to move. Yes, 2021 was a very busy year, and product in that specific complex is selling. Everything that has come up in this year has sold in a week, but that may or may not happen in slower years. Versus, if that is a big thing for you, if you don't know whether you're going to own this investment property for 2 years, 5 years, 10 years, buying the location is almost as equally as important as buying into a specific building. And knowing that in a slow year, like a 2019, like a 2008, 2009, that product still has a very good chance of being able to sell if you need to sell it. Again, like a lot of our clientele is younger people that are maybe upsizing from condo to townhouse or thinking about their very first investment property. And for a lot of them, cash flow is one of the more important items. And even just it seems like in the last 12 months to maybe 18 months, the rents have gone up significantly in a lot of the suburb markets.
Yeah.
And so that idea of being neutral 3 years ago was on that 1-bedroom condo in Burnaby New West, you're probably going to be negative $100 to $300 a month. And that, in a lot of situations, you're neutral or positive $100 to $300 a month now.
Yeah. I haven't seen many investments that have been cash flow negative.
Mm-hmm.
It's
recently, right?
Not recently. Yeah.
I think the rental rates in New West have been a little bit flat over the last few years. And I'm sure Burnaby's experiencing similar. Port Moody's definitely upward trending. I'm sure if you went out to Cloverdale, Langley, the rates are far higher than they used to be.
It's just because there's not a lot of products out there.
Yeah.
It's the same issue with the real estate market. needing more places for people to live. Like, it's hard to purchase a property. It's hard to rent a property. I mean, we put a townhouse on the market in the early spring of this year, early spring 2021. And we had over 40 people try to rent it from us within a week. We had to choose who we wanted to rent from, and we could ask whatever amount we wanted, and they would have picked it.
I think that's a good example of like the family tenant. You know, we most don't go after this, but you've had enough sales and you've seen enough that a townhouse, even an older one, if the rentals are allowed in an area like Port Moody, that's a very desirable product. Having a 3-bedroom townhome.
If you can afford a townhome as an investment, get a townhome. Get one. The rent is really good, and because of the family dynamics that rent into townhomes, they usually stay for a while, and it's not just cash flow neutral or positive. It's like, I think on our townhouse investment, we make about $1,000 more than what the mortgage is on that one. That's a lot. It helps pay my mortgage for the house I live in. So it's good. Yeah.
Sorry, Monica, favorite or?
Yeah, favorite for me would be townhouse. That's a big one. Yeah, that's one that I recommend to a lot of clients I have that own detached homes, and I've had a lot reach out to me this year because they're thinking about getting into an investment property, and I tell them, if they have the equity and the cash to put down on it, think about a townhouse over a condo, just purely because of the dollars. Yes, you're going to get around $2,500 to $2,800 for a nice condo, depending on the area, but you're getting almost double that in a townhouse. You get close to what you would get for a detached house in a townhome. A townhome is like the perfect kind of blend because it's a strata. So you're not going to be paying for a roof if the roof starts leaking. You're going to phone strata and say, hey, we have a roof leak, or something happened to the window, or the garage door is not working. That's all strata. That's maintenance that you're not doing yourself. If it's a detached home, you're sourcing somebody to fix all of those things. And if you really want, this is obvious, it's the oldest story in the book, like the more money you spend, the more money you're likely to make. So if you're spending a little bit more on the townhome, you're going to make a lot more in rent, and you're spending a lot less than you would if you're in a detached investment situation.
I think a lot of people get caught up, especially like younger first-time investors in something like strata, condo, or townhouse, get caught up in the sale price. So, oh man, it feels like outrageous to spend $1 million on an investment property. It just sounds like a big number. But if the numbers make sense and you're cash flow positive, the sale price doesn't really matter, right? What matters is, can you come up with the 20% down payment? And if the answer is yes, the cash flow in a lot of cities in Greater Vancouver is much better in townhouses versus condos.
Yeah, you're talking about like a lot more rent. It's just for not quite as much more of an investment. And again, like Denny mentioned earlier, it's not your money that you're spending, right? So it's totally worth it.
So I love it. Whenever I walk into a bank, I'm like, how much money will you give me today?
Yeah.
I'll take it.
Yeah, the banks determine your risk. You're like, I don't have to. Yeah, if the banks will give me money, sure.
Yeah, exactly.
On the townhouse note, do you find many older townhomes in, say, Tri-Cities or Port Moody, they have rental restrictions?
Some do. You have to find the right ones.
Yeah.
You have to know where to look. Townhomes that are new or built after 2008, of course, you're going to be able to get rentals in there. But if you go too old, you really need to know what the maintenance schedule is looking like on the townhome to make it a good investment. Yeah.
And a potential upside when you go too old is
development.
Yes. Yeah. There's that too. And what we mean by that is developers knocking on the door of a townhouse complex to put a tower up, and these townhomes that might be worth $1 million sell for 1.3, or a 30% lift or so. Okay. So I have one other question for you. Short-term furnished or Airbnb versus long-term unfurnished. Now, granted, we are all busy realtors, so we have a little bit of a lifestyle skew here, but do you run into, whether it's yourselves or clients, do you ever find people using short-term furnished rentals or Airbnb as a mode to get a little more out of their place?
It's almost like signing up for a job, right?
Yeah.
You're creating a job for yourself. And so for me personally, I don't have enough time to run that job. So the cash flow is important for me. If it cash flow neutral or positive, I'm interested in that as a long-term rental. But I see a lot of people doing really well with Airbnbs when you can find the locations that allow them in Greater Vancouver. They make a lot more money every month. I like to say you're signing up for a job. So is that a lot more money paying you enough to supplement your income? If the answer is yes, then I mean, they're really good investment properties.
So we're kind of doing, my husband and I have kind of done both. We had a property in Toronto that we didn't stay at year round. This was back in 2008, 2009, 2010. I don't know. This was ages ago. And when we would leave for 3 months, we would do short-term rentals with it furnished. And we got an insane amount at that time. We were laughing when we would rent it out for that much, but it was for our lifestyle. Like it worked perfect for our lifestyle. And we always knew we were coming back at a certain time and we could get it fixed up and that type of thing. We rent our basement now of our detached home furnished, and we do get a good amount because of the fact that it's furnished, but it's in our house. So if something goes wrong or we need to replace something, like they broke the microwave. Don't ask me how, but we just went and got them a new microwave. It was easy because it's in my house. So I dropped it off at their door. So it kind of depends. Like Denny said, you're signing up for a job and like people are crazy. People are nuts. You never know what they're going to do. They're going to break. So you have to furnish it with nice enough things that people will like them, but you also have to be comfortable with them ruining them. So I tend to err on the side of no furnished, unless it's something that's close.
Like a basement suite in a house.
Yes.
That might be the tempting Airbnb sort of. Yeah.
An Airbnb in the house that you live in, why not? Like you'll get a lot more if you or your partner always know that you're going to be around or available to do it. If it's in your own home, I would say try it out before putting a long-term tenant in there. Give it a try and see if it's right for you.
On the low end, it's probably double the income, I would assume. And
easily.
Quite possibly triple.
We see all the time listings, especially in Vancouver, that like part of the listing presentation is, we get $50,000 a year for our basement suite. That's hilarious. Like it's barely a suite. And we usually see like around 45 to 50,000 is what they're getting for one bedroom Airbnbs. Yeah.
I think I'll use this moment to share some of my history and lessons learned with being a landlord, because I've had a few over the years. So some of my principles of buying where you would be willing to go to, that stemmed from, I don't know, I think it was 9 years ago with a partner. We bought 4 homes in Atlanta, Georgia, in a sketchy neighborhood. And we bought there because of cash flow. $80,000 house rented for $1,300 a month. Problem is when the tenants moved out, the wires would get stripped, the appliances would get stolen, the AC unit would get stolen, and then you'd spend 20 grand getting it all fixed up and hoping that a new tenant would get in before it all gets ripped out again. That experience took 2 years of my life, ended up losing half my money, and recognized don't be lured by cash flow, because cash flow can be higher risk areas. It can be less desirable areas. And I think an example that I've seen lately that it's completely opposite of Atlanta, Georgia, in the neighborhood that I bought, that was that the contractors were bringing guns to go work on the home because it was that bad, is like I saw in Kitimat. And what's the oil sands town in Alberta? It's on the tip of my tongue. But long story short, Fort McMurray. The returns on rentals in those markets is far higher. Like in a commercial asset, you might see a cap rate of 8 to 10%. That a higher cap rate means capitalization rate, which is like your percent return on a property. That is usually like a higher cap rate means that it's usually higher risk. Like the investment, like if you bought a condo or a commercial asset on Robson Street in Vancouver, that might have a 2% cap rate. And so when you get lured to these other markets with an 8, 10% cap rate, you're arguably buying in a more risky market, a market that may go away if their industry goes away. So one, cash flow is not always my main criteria. So cash flow has to be hedged by some other things. 2, if you have a disgruntled tenant that won't move out, going through the arbitration and going through that process, yes, you got to do it. You got to get to the point of a bailiff showing up. But I would highly suggest you just rent a moving truck and help them move. The more that you can incentivize and even out-of-pocket pay for someone to move out of your property and even pay for, being a laborer and helping them move, you just want a tenant out of your property. That's one thing I learned on my son's first birthday. And 2, I don't know how the grow-ups, I unfortunately have owned a property that had a grow-up as well. I personally am not, other than lenders have an issue with grow-up stigmas. Maybe that'll change over time, but right now that is a genuine issue that may affect your loan. So that's a very good reason not to have one. But when a property has a grow-up, which I've had in the past, the remediation process gives me comfort that property is fine once it passes that remediation. So, you get electrical inspections, you have people come in, check moisture, different things. You have to get that grow up fully remediated. So if a property did ever grow up, other than worrying about drug dealers showing up at your door, the house structure itself is, for myself, no concern. And then after making all these residential stories and some mistakes, when what I find is most real estate investors eventually evolve into commercial. And so for me, my future, or my hope for my future in terms of investing, is looking at commercial, and that would be multifamily or light industrial outside of the city, in markets that are upward trending, just for better return, more bank money. And I just tend to find that most investors that do invest in real estate eventually evolve from residential to commercial. And a big incentive for that is the capital gains tax, which of course could change. It's a political topic nowadays. But if your house that you've been renting for 20 years goes up $1 million and you sell it, you're responsible for the capital gains of that lift. If you owned a commercial asset and you sold it for that $1 million lift, as long as if you reinvest that money within 12 months, you avoid the capital gains. And that's that's one reason to consider commercial. And if you're a high net wealth individual, in residential, your income stress test is really a limiting factor on how much you can afford and how much you can get a mortgage when you're buying residential property. In commercial, they don't look at the stress test. They don't look at your income the same way. They're more focused on your net wealth. So if you are an individual with a high net wealth that doesn't necessarily have a $500,000 a year income or a high income, commercial is a great way to leverage off your wealth. Anyway, that was a ramble.
Well, that's a good one. A little step further, you didn't mention this, is with commercial investments, usually businesses rent for a lot more too.
Oh, yeah.
So you're paying less for quite a bit more rent in commercial properties also. I know of one person in Port Moody that bought one of the commercial spaces on Clark, and it was, I want to say, just around $600,000, and they rent it for $4,000 a month to a hair salon. So that's a great investment.
I think that's probably a pretty common rent to asset price ratio. I heard a similar one for an office space in Langley that was around that. Yeah. No, so commercial is where it evolves, but it doesn't mean that, everyone's market. There's all these things to consider when you're thinking about being an investor. And I don't think you're going to figure it out overnight. I often find people need to stumble their way through it. It means take a leap at something you think will be a winner and recognize that if the market were flat for 5 years, which is very possible to happen, how will you feel about managing an investment that's flat for 5 years or more? And you have to be okay with those slumps, because usually after that 5-year slump, you got 5 years of gravy after, because the market's up and down. And that's where you can really make gains, is in those upward trending years. But between the upward surges, there's flat times that really test the investor. Anyway, Denny, anything to add there?
I like it.
I think we covered a lot.
Yeah.
That's all.
That's it.